Welcome to the Daily Update, where I'll go over the action in the market for Friday, May 19th, and then we'll see how things look for Monday, May 22nd. We saw a bit of a pullback. The action was a little bit more negative than positive. Not really a surprise. We do have some pretty significant overhead resistance in the S&P at 4,200. The market was looking a little bit exhausted. We're still showing some short-term overbought or extreme positive readings right now. Things still remain basically positive and they look like they're improving. But the big question now is, can we break through that 4,200 level and then close at that level? Before I get started, please note that I do have a supplemental video that you're welcome to watch. I posted that almost 2 weeks ago now, but the information is still very relevant. I do have a PDF of all the slides and charts that you're welcome to download and follow along. I do have a private Facebook group. I mainly use that to communicate with folks that enjoy watching the videos. I don't have a poll this week. I'll try to post one for next week. And I also post videos on Rumble. If you didn't watch the video for Friday, I had a situation on Thursday where my YouTube channel was taken down for about 3 hours until I heard back from YouTube saying everything was okay. But in the meantime, if you go to YouTube, you can't find me because of some threat of violation of some sort. Please go over to Rumble. I also post on that site as well. So let's go back and talk about what happened. We had a positive open, but prices did not get all the way up to R1. As the day went on, prices chopped sideways until selling took prices down below the unchanged level. And then we went down to the daily pivot at 41.85. Then prices kept chopping between the daily pivot and the unchanged level, and we closed a bit off of the low. We were down 0.14% on below average volume, which is kind of a surprise because Friday was options expiration. We typically see a real increase in volume on that day. The technicals are still pretty much positive overall. There's always some kind of warning signs that I'll go through and talk about, but inflation and interest rates are the real concern right now. At the top of the list is more this debt ceiling issue that's trying to be dealt with, and I have a little information to share about that. And then there was a little bit more banking information that we should probably talk about. So what are some comments that we can make? Debt ceiling and regional banks, those worries are still continuing. Mr. Powell, in his little chat with Mr. Bernanke, said that inflation is far above the Fed's objective, but he also said that rates may not have to rise as much because of credit conditions. This means bank problems. Then we also had a tweet from a place called Punchbowl, which I'm not familiar with. A fellow named Jake Sherman said that debt limit talks between the White House and White House Republicans have been paused per multiple sources involved in the talks. And then CNN also came out with a report that said Treasury Secretary Yellen told bank CEOs that more mergers might be needed. This could mean more smaller banks or regional banks get swallowed up by bigger banks. That suggests that there might be some problems in the banking sector. The 4,100 level is still providing significant support, and we also have significant resistance at the 4,200 level. On a short-term basis, we still have our CCI 14 and 20 that are extreme positive, the Stochk RSI, and the Williams percent R. And I'll show you all these charts. Intermediate term, we just have the Sean trend meter that's looking extreme positive. The dollar was down and interest rates were up. Now, the dollar being down could have given some support to stocks, but interest rates being up probably provided some headwinds. The 10 to the 5 has come back on our list now of being inverted, where the ones we're watching the closest are the 10 to the 2-year and the 10 to the 3-month. Those still remain inverted. Sentiment continues to be positive. It actually ticked up to 67 where it had been at 66. Our trend is positive and the green line showing some strength. The ADX has crossed above its moving average now. So if you're really aggressive, you kind of like that. We would default to the positive side because that green line is on top. But also be aware if you're more conservative that we are still below 20 with the ADX. Our bias I've still kept it positive because we had 2 pretty significant up days in a row. Even though Friday was down, it wasn't down all that much. And I've also kept our momentum at positive. Now that could all switch after Monday, but for right now, we're still headed in the positive camp. We didn't have any economic reports that came out on Friday. Looking at some Isabel net charts, this came from realinvestmentadvice.com. This is the PPI to CPI spread, and then comparing it to the S&P 500. The black line is the S&P, how it's been showing a little bit of improvement. And then the spread between what producers pay and what consumers pay is also continuing to decline. Now, is AI going to be the next bubble? We've had the dot-com stocks back in the late 90s. We had real estate that led to the great financial crisis. We had gold in about 2011, 2012. We've had cryptocurrencies come to the forefront. Now, is artificial intelligence going to be the next real bubble that people start to get into? We can see right now AI is not really registering on this list of different bubbles that we've had. Also, looking at the forward PE ratio, we're at 18 times earnings. That's above 15, so we're above being fairly priced, but it's below 20, which is considered to be expensive. The Deutsche Bank recession probability, it's back to 100% after different things have happened lately. And then the LEI, which came out on Thursday. This is a chart that I was waiting for where we ticked back up slightly, but we still continue to decline overall. When we're below this red line, that means that we have a signal for a recession. Also, we had the latest reading of the active asset managers. I'll include this in the weekly video as well. They came in at 59, which is pretty much at the midpoint right now, not extreme positive or negative. FactSet had another blog post on Friday. It says fewer S&P 500 companies are discussing recession on their earnings calls. Last time I posted about this, it was were they talking about inflation, and that has dropped. Now the talk about recession has also dropped. We see over here on the right-hand side where it is going down overall. Getting into our analysis, here's the intraday chart where we did go up higher. We had a positive open, but we never got up to R1. We just chopped sideways. When we couldn't break to the upside, we ended up falling down below the unchanged level, came down to the daily pivot, and this ended up being support throughout the whole day. And then we bounced around between the unchanged level and the daily pivot, and we did close off of the low. Here's the 10-minute SPY intraday chart, where in the overnight session, we saw a little bit of weakness, and then we were just pretty much chopping sideways. We started to get a little more positive before the open, but then things were quickly taken down negative. And then going into the last part of the trading week, we are showing a little bit of an advance. Growth is still continuing to outperform value. And here's the intraday chart. When we're going up, that means the growth is outperforming value. And here's the closing values where growth was up, where value had been down. It was down less with the mid caps and also less with the small caps. A lot of the selling that we saw taking place on Friday was in the value areas. Looking at sentiment, we're dropping continually with our Ulcer Index suggesting that fear is very low. Here's the VIX, which actually ticked up with the slight down day based on the line chart and on the bar chart. The VIX of the VIX really did spike up. This might have had something to do with options expiration. And here's the MOVE index on top, which we're pretty much going sideways. This measures the volatility of bonds, where the VIX measures volatility of stocks. The green line here is the spread between the two, and the red line is the S&P, and they still have a pretty strong correlated relationship. The SKU index pretty much at the midpoint right now, not getting any extreme readings. Another fear gauge that we look at did tick down slightly, but we are continuing to go up overall. And this other fear gauge dropped a little bit on Friday, but continues to pretty much chop sideways. This is also a potential change. We're seeing a real improvement in the high beta stocks starting to outperform the S&P 500 equal weight ratio. This could signal that folks are getting out of this risk-off environment and coming back more into a risk-on environment. Advanced decline line, we were down a little bit based on price and volume. We are seeing a short-term negative divergence and also a longer-term negative divergence. The new highs and new lows are showing some improvement, and we've crossed over positive with our 5 period, and we're still going up with our 10 period. So this is improving, but it did lag. But at the same time, we were in a trading range, so it's really hard for a lot of stocks to generate a new 52-week high. The advanced decline ratio is just about at the midpoint currently, and accumulation distribution continues to be positive, even though it did decline slightly. We're still looking at negative divergences when we compare the S&P to the NYSE advanced decline line studies. The NYSE advanced decline line itself is showing some improvement where it came down to this trend line and so far has been holding up above that. The common stock also showing a longer term negative divergence. Looking at our broad measure, the NYSE came right down a little bit below the moving average. The S&P declined also, but is still above its moving average. The mid caps are on the moving average. The small caps tried to come up to the moving average, but showed a little weakness on Friday. Looking at our trend, the ADX is showing some strength. We're above the moving average and it is climbing. If you're really aggressive, you probably like that. You would also default to the positive since the green line is on top and the red line is declining. But overall, if you're more conservative, we are still below 20. Volume did turn down slightly. We were a little bit below average. On a short-term basis, we still have some overhead resistance, and the 4,200 level is also acting as resistance. In the short term, the Stochh RSI is still extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20. They're all extreme. Looking at our stochastic study, we're coming back down a little bit in the short term, but still extreme positive. We're going back up into extreme positive with the intermediate term, but showing some improvement with the longer term stochastic. The force index, even though it declined, is still positive. In the intermediate term, the balance of power still is showing some weakness that it's picking up in the market. We're still above both the double and triple exponential moving averages. The go-no-go system still remains positive. The TTM squeeze is also showing improvement with the blue bars. And we're coming back down into the second standard deviation on this chart. And we're coming back down from the upper Bollinger Band. In the PPO study, we're still positive in the long and intermediate term, and we remain above zero in the short term. Our Arun indicator is showing the oscillator continuing to improve and has now switched to positive. We're still seeing some negative divergences with the McClellan oscillator. We came back down below zero. The NYSE McClellan oscillator also dropped below zero with negative divergences. The Swenlin trading oscillator, this could be kind of positive. We went above the zero line based on price and volume, so this is showing some internal strength. Looking at our other PMOs, we're still seeing this longer term negative divergence. We tick down just slightly with the percent of PMOs that are rising. The buy signals continue to go up, and we're pretty much flat with the percent of PMOs above zero. In our other PMO study, we have crossed over positive with the indicator itself. We haven't crossed over positive based on price, but we have crossed over positive based on volume. The Elder Impulse system for the S&P remains positive with green bars. Parabolic still remains positive with the dots underneath. And the slope is also starting to turn back more positive, as is the MACD. Here's all of our other oscillators with the slope and MACD turning positive, the TSI is turning up, the PMO is just getting ready to look more positive, the PPO is positive, longer term, the TRIX is starting to turn back up, and KST is turning up, but our longer term oscillators still remain negative. The Sean trend meter is looking extreme positive. We're still above all the plotted moving averages in our moving average tree. The BPI, after coming down to 50, has now bounced back up. That is positive, but longer term, we still have this negative divergence. The NYSE bullish percent index is not turned positive. It's still below 50, even though it did advance. The Chaikin money flow continues to be positive, and the Chaikin oscillator also is above zero. The money flow index still is below 50, so that is negative. The vortex, even though the green line declined, is still on top. That's positive. The ultimate oscillator declined a little bit, but is still above 50. That is positive. On balance volume, we tried to come up above this moving average, but now we have dropped back down. That switched more to negative. The summation index based on price is still declining and pretty much flat, where we have turned up based on volume. So we're seeing a little discrepancy here. We'll be watching to see if price can follow through what the volume indicator is suggesting. We're still seeing a longer-term negative divergence when we look at our 250 period moving averages. The S&P had been breaking out, but we're not seeing that with the 200 or the 50 period study. The Kopik curve has generated a buy signal. Some Fibonacci and line studies were still above this 4170 level. If we fall, will that provide support? That's about 21 to 22 points above current price. We have been able to break above this 50% retracement level at 41.91 or 92, where if we fall, we're looking at 41.56 to hopefully provide support. Longer term, if we really start to fall, we're looking at 40.20. We're also wondering if we've hit this upper resistance at about 4,200. We came up to this red line. Are we going to start to turn and go in the other direction? Now, when you compare that with this next chart, we have now reached the end of this 50-day cycle. Sometimes, if you look back over the last year or so, these lines have signaled some kind of a reversal. Is that what's going to happen now? Also, another support level based on a commitment of traders report suggests that we have pretty significant support at the 40.80 level. Our different charts, we're still looking good with the Heiken Ashi. The Kagi chart is also positive. The Renko chart is also positive. And the 3-line break remains positive. We don't have any changes in the point and figure chart, but on Thursday we did have a double top breakout signal that was generated. Looking at our different indexes, the equal weight continues to underperform the S&P. Here's another shot of that same study showing how the big boys have been outperforming the smaller crowd. Looking at new Dow theory, we're still above this blue line. We seem to be hitting resistance at about the 4,200 level with the S&P. Looking at the NASDAQ, we're still looking like we're breaking out. The transports continue to underperform the Dow, which could be longer-term weakness. The Dow is still above its 50-period moving average. It did drop down below this support level. And the diamonds, though, still remain positive. The NASDAQ still looking positive and that it could be breaking out. The NASDAQ is also above this 32.8% retracement level. That's about 150 points away from current price. So if we fall, we will be looking to see if that provides support. But when you compare the S&P price action with the NASDAQ new highs minus the new lows, we're seeing a pretty significant negative divergence. The NASDAQ 100 also continues to break out even though it was down on Friday. The Qs still remain positive. We're still above this 50% retracement level at 13,614. We closed at 13,803. I showed this in yesterday's video. This is research put out by Tom DeMark. I have a link to his book in the description. This is just suggesting that the NASDAQ 100 may be hitting an exhaustion point. But if you look at the BPI, we're still showing an advance for the NASDAQ 100. We're still above this anchored moving average going back to the all-time high. This is a weekly chart. The small caps are showing some improvement but closed down below the pivot level. And we're also above 50 with the RSI, but it did decline. The MACD is still trying to suggest things are turning more positive. The small caps to S&P 500 ratio is improving slightly, but they're still underperforming overall. The Elders Impulse system for the small caps remains positive. And here is the internal strength that we're seeing from growth stocks when we compare it to value. The mid caps were able to get above their pivot point, but they lost it and then closed right at their 50-period moving average. The mid caps for the Elder Impulse system, though, remain positive. And we're also seeing internal strength when you compare growth versus value in the mid caps. The micro caps are still above 100, and they were actually up on the day. And then we're still looking at a longer-term negative divergence when we compare the Dow with the Dow transports, and we're seeing some real recent weakness in the utilities. The home builders dropped a little bit overall with their ETF as the S&P came down. The ratio came down just a little bit, and the relationship weakened, but they're still having a tendency to go in the same direction. Keeping an eye on the financial sector, we were down almost 0.5% and continue to be in a downtrend. The financials continue to underperform the S&P, and the regional banking ETF continues to underperform the financial sector. Interest rate studies were still coming out of our rainbow, suggesting that we might get into a soft landing for the economy. And also growth is really outperforming value when we look at this chart. Looking at bonds, interest rates were up and bond prices were down on Friday. The correlation is still starting to weaken longer term. It's also weakening shorter term because the spread continues to be pretty far apart when you look at the S&P and compare it to the long-term bond ETF. Our long-term analysis, we're still having trouble with the special K being able to break through this red line. Also, another look at our long-term analysis, the MACD continues to go up, which is suggesting that this breakout above the trend line is legitimate, at least for now. An update of our possible positive scenarios. Growth was up in Friday's session compared to value, and we're seeing some strength overall going back to the beginning of February. Looking at the Qs to the S&P, where the Qs are outperforming. Discretionary ticked down just a little bit after it had a good day on Thursday. Large cap growth continues to outperform large cap value. Looking at our growth to value ratios, the large caps, mid caps are looking okay, but the small caps are improving a little bit, but lagging behind. This is another potentially positive thing. We're seeing that as the utilities are falling, the S&P's been doing better, so this ratio is starting to go up. If you go back and look at what this ratio was doing, when we really hit some really strong up times in the S&P, this ratio was going up. When we turned and started going down, this often also signaled a top in the S&P. Well, to see this improving is positive overall. But when you look at the broad market of the Amex, NASDAQ, and NYSE, and then look at the highs minus the lows and take a 5-period simple moving average, we still remain negative. But longer term, when you look at a 50-period moving average of the new highs and new lows, we're turning back up slightly with this chart because our indicator is still giving us a reading of 23. We're still above zero with price and volume when we look at the 19-day exponential moving average of the advanced decline ratio. And the 2-year Treasury yield, after spiking up, has been coming back down. Now it's starting to go back up. Will this provide some support for stocks to go higher or some headwinds? But this is also looking a little more encouraging. The staples to S&P 500 ratio is really starting to fall. When we spike and then begin to go down, that has often marked some pretty significant upward movement in the S&P 500. So what's our outlook for Monday? We're still dealing with earnings season. The technicals are pretty much positive overall. We're breaking out, but we have that resistance above us at 4,200. Are we getting exhausted right now? We don't have any economic reports again on Monday. And then the whole list of geopolitical events, it's probably going to be mostly about the debt ceiling for right now. But in the background is this inflation and interest rate scenario, as well as any more banking information that may come out. Looking at the Stock Traders Almanac statistics for May. Now, we just finished with options expiration, so the week after, we end up being up 64% of the time and down 36% of the time. When we look at May 22nd, we're kind of negative overall. The Dow's up 33.33% of the time. The S&P is a little bit better, being up 42.9% of the time, or the NASDAQ is even a little bit better, but still neutral to negative, being up 47.6% of the time. And then we are potentially heading into that weaker part of May. We are starting with the 16th trading day of the month on Monday. The green line does show that it does decline and continues to do that throughout the next few days in May. But when you look at this, we're focusing in on the black line, which are all pre-election years. And then we're also focusing on the green line, which is looking a little bit better. But when you just hone in on May, we do see some weakness with both the green line and the black line. And then we also tend to be more positive when we had a bear market in the previous year, which is what we had. And then we're coming into a pre-election year. This is still positive overall out of this 6-month study that the Stock Traders Almanac has conducted. This chart just shows the similarities between what's happening now, that's the blue line, and what happened back in 2011, and then different events that ended up happening. We may see some weakness, but that could be more off into the future. So our scenarios. Can't really go with the down one right now because we're more positive, but we do have negative divergences and a pretty weak trend. You could go with the positive now if you're pretty aggressive. If you think we're going to break out above that 4,200 level, if you're more conservative, you probably want to wait. So we still default to the sideways or neutral trend because our ADX, even though it's getting stronger and it's above its moving average, both of them are still below 20, but it is positive with the green line continuing to advance even on a down day. Warning signs. We still have a lot of negative divergences that are all coming together. The VIX is still showing a lot of complacency. The S&P new highs are lagging, but they are showing improvement and starting to turn more positive. The NASDAQ cumulative new highs, new lows is showing a real negative divergence. The S&P is underperforming utilities, but it is showing some improvement. And that's that chart where I was saying, let's keep an eye on that. Where the risk-off posturing that we've been seeing may be starting to change. The small cap index is underperforming. The mid cap index has generated a recent death cross. Is the NASDAQ or NASDAQ 100 getting exhausted, suggesting those charts that I was showing you? Earnings season continues, but it's starting to come to an end, and that can be either positive or negative. On the positive side, the Copic curve generated a buy signal. The longer-term seasonality and setups that we talk about periodically, those still remain and apply to the whole year. Lower price levels may provide support. We're looking at the 4100 level. If we drop below that, the 4080 level, possibly the 4020 level. The NASDAQ is still breaking above resistance. Small and mid-cap growth is showing some pretty significant strength. And is the market bottoming that we've been going through the last few weeks? Is that consolidating by moving sideways? And if they do resolve this debt ceiling crisis, will that lead to a short-term rally? We had pretty positive days on Wednesday and Thursday. If they come out with a deal, will it be a sell the news type of scenario? So our conclusion, the S&P, it's positive. The trend is there, but it's not very strong and showing a lot of negative divergences. Are we breaking out? Are we getting exhausted? Will we be able to get above this resistance? In the short term, we still remain positive, intermediate term positive, and long term positive. Also, I wanted to include this now. You may want to pause and look this over. I just offer this as educational and entertainment. Please don't think that I'm a financial advisor of any kind. Also, I want to make sure that I give credit to other sources that I cite periodically. Those are all listed here, as well as the different links where you can find that information. So thank you. Have a wonderful weekend. I will look at preparing the weekly video, the intermarket analysis video, and the deep dive video over the weekend and have them posted before the market opens on Monday. So have a great weekend, and I will talk to you in the next video.